I wasn't able to attend all the presentations today, but for those I did attend, and from what I heard during the cocktail hour, they were well received and were very interesting. So congratulations to this organization for putting on this terrific forum. For this evening's talk, the direction I received from George Schultz and John Chauvin was very clear and very blunt. Even a banker could understand it. They said, please explain what in the hell happened, why did it, and how might we avoid it happening again. So that's pretty straightforward. So I'll get right into it. But before doing so, let me read you a very interesting quote. And while I read this, think about who it's from. Quote, owners of capital will stimulate the working class to buy more and more expensive goods, houses, and technology, pushing them to take more and more expensive credit until their debt becomes unbearable. The unpaid debt will lead to bankruptcy of the banks, which will be nationalized. The state will then have to step in to save the banks, which will eventually lead to communism. Who said that? Karl Marx in 1867. Pretty scary, isn't it? With that good news, I'll go forward. This is the sixth economic recession that I have experienced in my business career. The worst one so far was back in the early 1980s. I know some of you remember it. We had the Arab oil embargo, 14% inflation, 20% interest rates, 11% unemployment, and a very, very restrictive monetary policy. The vast majority of savings banks failed, as well as many commercial banks, especially in Texas. The Continental Bank in Chicago failed, which at that time was the largest bank failure in U.S. history. It was actually nationalized and sold 7 years later. Banks were saddled with LDC debt that needed to be restructured, especially in Latin America. By the way, if banks had to mark-to-market their LDC debt back then, as we do now with so many assets, every, and I mean every, money center bank would have been bankrupt with practically no access to additional capital. Now, although the economy has still not hit bottom by any means today, and we have but today we have 8.1% unemployment, record low interest rates, low core inflation, and the most expansive monetary and fiscal policy in the history of the United States. In stark contrast, the inflation was so high during the 1980 recession, the Federal Reserve mandated that banks reduce their lending, not increase it like they are demanding today, in order to slow the inflationary economy. Banks face fines and other sanctions if loans outstandings increased. Banks totally cut off their lines of credit to their customers. In spite of such dramatic differences, most everyone thinks this is the worst economic crisis since the Great Depression. Why is that? I would call it the worst financial crisis, perhaps, since the Depression, but I believe the 1980s was economically much worse than this one, at least so far. So, what did happen? Why did it happen? What is different about this recession? What is different is that in all the previous banking crises, it generally started with the bank's customers having problems due to macroeconomic issues and the economic cycle. This eventually led to credit problems and the write-down of loans and assets. This time, financial institutions themselves caused the problem, not broad economic factors, not the economic cycle, not misguided fiscal or monetary policy, not an oil crisis or a market disruption. Let's be honest. This problem was caused by a total disregard by financial institutions' management of basic risk management fundamentals, even common sense, coupled with a serious lapse in ethical behavior. It was fueled by greed, unchecked by regulatory authorities, and reached an unprecedented scale due to the breakdown in previously reliable third-party safety valves, namely rating agencies. Let me ask you these questions. Is it ethical to record on a mortgage application an income that you know is wrong? Is it appropriate for a firm to sell investors a security that the firm itself is shorting? Isn't it just common sense that, especially for subprime borrowers, that stated income, negative amortization, teaser rates, no-doc, and low-doc mortgage loans, primarily originated by brokers, are inappropriate, should never have been offered, and are an open invitation for fraud? Could this subprime fiasco have reached the bubble level it did without AAA ratings from rating agencies? Could it have reached that level if mortgage brokers had been properly regulated by their state agencies? Aren't all of these relevant questions that we should be asking so that we learn from our mistakes? What is so unfortunate and so puzzling about this crisis is that it should never have happened. It was not caused by normal economic issues. It was caused by human error and human malfeasance. Perhaps this is why we have had to use such non-traditional methods to try to fix the problem. The old tools aren't working because the cause of the crisis is so unique and so different. It reminds me of the story of three men who were about to be executed during the French Revolution: a soldier, a politician, and a banker. The soldier put his head on the guillotine. The blade stuck. He went free. The politician put his head on the guillotine. It stuck again, and he went free. So the banker was next in line. And he'd been watching all of this, and he looked up at the blade, and he said, "I see the problem. Oil the hinge." Yes, we bankers often cut our own throats. The seeds for today's problems were sowed in the 2005 to 2007 time period when credit risk spreads were the lowest they had ever been across almost all asset classes, 50% or so narrower than their long-term averages. The market was pricing as if there was no risk. Many investors were looking for just a little more incremental yield, while they generally ignored the very substantial increase in incremental risk. This opened the door for the greed and ethical lapses that I mentioned earlier. Cleaning up this mess has unleashed massive monetary and fiscal stimuli never before contemplated, yet alone used, not even during the Great Depression. Incidentally, there have been many articles and comments in the media comparing the current economic challenges to the Great Depression. Factually, there is not even a close comparison. The Depression's loss in GDP was about 10 times the decline in all the recessions we have had thus far in the 20th century combined. In the early 1930s, GDP fell by about 30%, industrial production by almost half, unemployment exceeded 20%, and of course the Depression lasted a long time, practically the entire decade of the 1930s. In fact, unemployment did not fall to single-digit levels until the beginning of World War II. We are far from these dire economic levels, and I see no chance of even getting close, given the coordinated fiscal and monetary policies taking place around the world. The fourth quarter GDP decrease of 6.2% is startling to many, but we forget that we have had quarterly decreases in GDP of around 5% or more in many past recessions, including 1948-49, 1953, 1958, 1960, 1974, and of course, again, the very difficult early 1980s. Nevertheless, the recent economic changes have been dramatic. In the past year alone, we have seen stock markets across the world fall by half, erasing $35 trillion from investors' portfolios, about $8 trillion in the U.S. markets alone. For most Americans, their 401ks now look more like 201ks.